I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. My co-host is Mike Philbrick of Resolve Asset Management, SEZC. Welcome to Raise Your Average. Our guest today is Mark Noble, Executive Vice President and Educator-in-Chief at Horizons ETFs.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Mark, welcome to the show. Thank you so much for joining us. It's great to get a chance to hang out with you for a while.
Yeah, thank you. It's always great to hang out with you, Pierre and Mike.
Mark, it's been quite a year. You and I spoke about a year ago. It's hard to believe that it was a year ago already. To kick things off, why don't you take us back to a year ago and tell us what kind of a year it's been for you, and then we can get to some of those.
Can we also, Mark, in that? Can you just give us a little background of who you are, where you work, what your role is there, so that most people will be aware of that, but there are some that won't be. So weave that into what Pierre's asked as well.
Yeah, so my role is Executive Vice President of ETF Strategy at Horizons ETFs. I'm not entirely sure what I do in that role. I mean, I do a lot of things. I tend to just focus a lot on the sort of education and product strategy. So I work a lot on product development. I actually know what I do, but it can seem nebulous for people that they're outside the firm. I focus a lot on the product development side, and then talking a lot on sort of working with how do these products fit for a portfolio? How do they fit for an investor? We have over 95 ETFs. So it kind of falls to me and my team of people that work with me to kind of curate and determine, what is kind of working right now from a product perspective, and then working with education and investors, especially a lot of self-directed investors, on where does this stuff fit from their investment goals. In terms of my background, it's a little unconventional. I was a journalist before I entered the ETF industry. So I started as a writer, writing about ETFs as a self-directed investor, working for a number of publications. And once I kind of saw the potential for ETFs, I decided I actually wanted to jump over and get in on an ETF firm. So I started from that end as opposed to the portfolio or finance side, which kind of puts me more kind of in a storytelling kind of ethos and how I approach things, which is a little bit different. And then I'm not coming from someone who's actually managed money. I'm coming more for the experience of someone who's just really interested in the technology of investing and then how it relates to how investors build their portfolios. In terms of what's happened over the last year, it's actually astounding to me how well a year it's gone for most asset management firms. Like my firm, for example, last year and coming into this year, we raised probably close to about $7 billion, almost doubled in size in terms of our asset growth. And we've seen a lot of other ETF firms sort of similarly see just absolutely astounding growth. We continue to see record inflows into ETFs. And it's really being driven by what is sort of an inflection point in that we're having a lot of new investors come into particularly the equity market. So I'm looking at a lot of data for investor economics, for example, and you probably have about 3 times as many self-directed accounts opening up as you are direct accounts. And historically, if I was to try to put this at a kind of a similar time period, you'd sort of have to go back to sort of like 1994, 1995, when the boomers started to hit sort of their peak earning years to see this kind of movement of new investors into the complex. And I don't know if it's the pandemic that started it, but certainly it's driven a lot of new investors into the market in sort of, and demographically, it's 25 to 40, so younger skewing, probably more like 25 to 35. And it seems to have brought in enough additional gasoline to the equity fire that it started to move valuations and move the market. And now you see traditional sort of retail investors also jumping on. So, we got stats last week that, for example, that more money was raised in equity funds in North America, over $500 billion in the last 5 months than has been raised in the last 12 years in terms of the acceleration of growth into equities. Wow. And, I think a lot of it is being driven by this small little snowball of new investors, which, Mike will know more about, but really cascades into, a larger sort of movement as they kind of move algorithmic trading and valuations and everything else.
It's interesting. Where do you think that is it their earnings power? So obviously that cohort is sort of the millennial cohort that you're talking about to some degree. They're coming into higher income earning years. Do you think it's their savings that is being sort of invested? Are they borrowing to invest? Where has the money come from, I guess is what I'm asking. Any insights on that?
Yeah, it's sheer volume of small dollar accounts. So like when you look at GameStop, for example, I think they estimated at some point in time that something like 24% of Americans own that stock. But to give you some like equivalent stats, it's like 7 or 8% own ETFs in general, right? So you have this huge cultural zeitgeist happening around investing. And again, these aren't people that are putting $10, $20 million into these, right? If we look at stock ownership in the United States, 70% of the stocks are owned by institutions, pensions, RRSP accounts, IRA accounts. But if you take the smaller segment of smaller cap stocks and you start putting, 3-4 million investors at $1,000 a pop into some of these stocks, it starts to move. And then algorithmically, everything's algorithmically on Wall Street. So if I start to see someone moving the needle, even if it's, 3-4 million small investors moving the needle on these mid-cap stocks, they start to move really fast and it becomes self-perpetuating. And we definitely see that in the ETF market where, the single largest growth in ETFs this year has been overwhelmingly thematic ETFs, which have increased over 400%. Yeah. It gone from $26 billion last year to over $140 billion in assets under management in North America this year.
That's amazing. So
remarkable, yeah.
Yeah, so you have a bit of a feedback loop, and I'm going to guess or postulate that some of that is driven by the gamification and the broad sort of access to markets in a way that has been democratized, made easy, made fun with respect to either Robinhood or other account opportunities where the account opening process is very easy. It's on your phone. It's easy to understand. You're given access to tools that have largely been the domain of institutions for a long period of time, and you're given them very quickly. Do you think that's played a role, or is that just me dreaming?
Sure. I mean, certainly, I think ease of access has to have come into play in terms of the fact that you can, do commission-free trading. You can buy fractional shares on Robinhood and fractional shares on other brokerages. I also just think that, again, I don't think this is unique, right? Historically, if we go back to 1994, 1998, everybody was a genius in the market, right? Like, do you know what I mean? When it came to generating returns. Sure. And we see the same thing with Canadian housing, right? Which is the leverage on people's balance sheets with their real estate is crazy, but nobody's complaining because they've had 164% returns over the last decade or more on their housing, right? Or, it just absolutely astounding numbers. So I think it's a combination of what you're saying, Mike. Again, it's hard to know without surveying all this, but a combination of what you're saying on the gamification, as well as the fact that nobody's been penalized yet, right? Nobody's really lost money in the equity market to do otherwise. So you just have more money piling on as, I would say the financial literacy litmus test gets lower and lower and lower, and the number of Instagram influencers making millions of dollars goes up and up and up. So.
And it's interesting on the point of thematic. I've certainly always been a fan, and I think the sort of the typical way it's referred to is core and explore. Right. And it kind of comes down to, or I'd like your opinion on this, but to my mind, it comes down to what's the investor's objective. So if the investor's objective is sort of outsized, differentiated returns, well, then they would have to take a very different approach. And if we think about market capitalization weight indexing, which has also had quite a run, and, as much as thematic investing has grown dramatically, if we look at that vis-a-vis the money that's gone to Vanguard and BlackRock, it's still relatively small when you compare the total inflows to ETFs, I think. And so the idea of the thematic investing to me is quite it's a good one, in that if someone's goal is to categorically outperform indexes or want to do something different than indexes, you have to take a different approach. And one has to respect market capitalization indexing for what it is. And that is simply that whatever has happened in the past will continue in the future. And whatever changes exist in the index, well, they're going to change and there will be some waves of change, but you're going to be participating in all those changes. But in the end of the day, it's saying, here's the capitalization weight and you should own that. And it kind of skews quite heavily to what's happened in the past. So if you think of some of the top weights in the index today versus the top weight of Exxon in the index in 2008, it certainly, wasn't the best forward return to buy the index. Obviously changing it does, or adapting to the change ahead of time, if you could do that, would. But thematic investing seems to me is taking a look at the world and seeing where there is the opportunity for pretty significant change that is going to create some sort of disequilibrium.
Right.
Right. And I know, actually you and Horizons have had quite a journey, not just recently in this, being the first movers on marijuana ETFs as an example. And so when you guys are thinking about what's the next thematic ETF to pursue, or what's the next item that you think will be widely adopted and thereby be a successful launch at Horizons, what do you look for in that sense? What are you guys looking for to be those large disequilibrium events where potentially they're underpriced and there's an opportunity for investors to participate, and where you think you can offer a solution that's going to help them do so?
Well, these are all really great points, Mike. And the thing when we're looking at thematic ETFs and thematic investing in general is you have to realize there's a boom bust cycle to every type of disruption. So if we even go back to the 1870s, right, we build the railroad, which opens up a whole number of economic possibilities, but it also crashes the U.S. economy. Okay,
right,
because of the amount of money that goes into it. Right, you end up with the railroad. If I go back to the late 1990s, we get the internet. Right, but the point is, if I go back to you in 1999 and I say, look, I got a company, we have sort of a 70-80% market share in mobile phone technology, where you can email, you can write down what you want. You can send emails. You can, wear it cool on the side of your pants, right? With your pleated pants. What do you think?
Oh God, that is close.
This sounds awesome. I'm going to buy Palm Pilot, right? So you end up just piling into Palm Pilot, right?
I was going to say,
okay,
it was a little close to home.
Yeah. So okay, but we're all there. We get the idea that this is real technology. There's something to this, but you have this massive boom bust cycle. If I put my money into Palm Pilot and then afterwards, RIM, which is a totally different company now, you went through that boom bust cycle. The idea behind thematic investing is really to just take the most basic tenet of investing, which is diversifying risk, and then going after that theme. Because if I'd owned the NASDAQ 100 instead of buying, pets.com and amazon.com and Alta Vista and AOL and Google, some of those are winners, some of those are gone. If I pick the losers, it's game over. If I pick the winners, absolutely, you've done extraordinarily well. But even the best foresight of the best business strategists would not be able to predict that. So a thematic ETF diversifies your risk and allows you to invest in that theme. But you're absolutely right. It's got to be in the Explorer. So the first thing I tell people before they want to invest in marijuana is I say, are you willing to lose everything? Well, the answer is no. But at the same token, that's how it has to fit into your portfolio. Because if I look at our Horizons Marijuana Index ETF, there's a good possibility that maybe only 2 or 3 of these companies are around in 5 to 6 years, even though the marijuana industry itself, I do believe, will probably be about $150, $160 billion business globally. And, it's already a $40 billion business globally. But determining who's going to win with that is not there. So that is really the key with thematic ETF investing. My big concern over last year, as someone who looks at thematic ideas, is that a lot of these themes have gotten way ahead of where they should be from a valuation standpoint, and that the ETFs themselves are wagging the dog. I don't want to name names, but there's one very extraordinarily large thematic ETF where it has over a 10% ownership in 26 companies in its portfolio.
ARC? I think you're talking about ARC.
I am talking, but I got to be careful about how I mention things. And
you can't
very
say
forward-thinking, very forward-thinking strategy that has a massive amount of ownership, concentration ownership in these stocks, because they tend to have a smaller cap. Even our marijuana ETF at a certain point in time, when it was over $1 billion, it's owning, some of the largest shareholders in some of these companies. So as more money pours into the ETF, it brings the valuations up, And then more money pours into the ETF and it becomes circuitous. What we're seeing, though, is as I go back to that discussion around self-directed investors, is they're really the ones that are starting to drive this up. And so we're getting, valuations that seem very divorced from reality on a lot of these themes, which, a lot of these companies, like even in marijuana in the Canadian LP space, they're trading at negative valuations. They're trading at negative earnings. Sorry, not negative valuations, negative earnings. And so you have all of this money coming in. $2-3 billion has gone into marijuana ETFs. And it really has sort of divorced from reality some of the fundamentals on this. So that's my big concern. Again, it seems to be setting up for a bust cycle. And really, at the end of the day, these themes, which are, supported by science and economics, whether it's growth of marijuana usage, whether it's growth of genomics, space exploration, these are real themes that are transformative. But as we all know with all things in investment, at what cost is it worth getting into? And right now, it seems extraordinarily high.
Well, it's interesting you mentioned that because sorry, Pierre, go ahead if you.
No, you go ahead.
So the construction of a theme is a very interesting thing, right? The idea of a theme when you started marijuana or some of the sort of more unique, transformational new ideas, that's one way you can get a thematic position. I think the other sort of contrasting that with another different type of theme, for example, uranium.
Right.
Under-owned, under-researched, Fukushima-esque cloud hanging over it. Yet fundamentally, certain drivers and certain structural changes are occurring where the last 15 years of the experience one has, or maybe it's less than 15 years, but last 15 years of the experience of the investor in that field might be changing.
Correct.
And I don't know that those valuations would reflect that same sort of euphoria or not. What are your thoughts there?
Well, Nick Picard, who works with us, focuses a lot on uranium, and we have Canada's only uranium ETF, HURA. And yeah, his view is uranium should be hitting about $50, right? I think it's down around 22, or even below that. The reason being is as we move to clean tech energy, particularly in Asia, there's simply not enough supply for uranium. A lot of these mines shut down over the last decade, which has completely undermined this growth. And then you had the U.S. government in the last year actually suggesting that they want to have a safe and secure stockpile of uranium, which means that you can really only buy uranium from Canada. So if that's the case, and you take out, Russian sources and Kazakhstan sources of uranium, then you really reduce the amount of pool in North America of uranium that could be purchased. So you're absolutely right. You can end up with pockets of huge valuation. I guess uranium kind of is an outlier in that it's not new, right? I mean, we're talking about a very old technology.
Yeah, it's just a different play on it. So people shouldn't forget, or investors shouldn't forget, that thematic investing isn't just about, it's the next new thing or it's a demographic story. Right. It's a function of both. It's the Overton window. Right, that the way that things go through the general zeitgeist of the public, where at one point they're considered ridiculous, ludicrous, and unthinkable, and as they pass through that window, they become fully acceptable and obvious. Right. And so, I think what we're trying to tie in here is the idea that, there's a theme, but there's also a valuation. What am I paying for that theme?
Right.
And from an outside view, what's the potential growth? What am I paying in wherever I am in that growth cycle? Am I overpaying? Should I be overpaying? There's lots of cases where in certain thematic areas, you could not have got in had you wait to pay a reasonable multiple. And so,
I just think we've had this, 10-year period of FOMO where people are contemplating getting into these thematic plays. The big one, of course, being technology and innovation. And all the while, the entire time that the contemplations have been taking place, people have spoken out against the valuations of these companies. They're very expensive. Oh, it's late. You missed the boat. And I think the last 10 years sort of, even though it's created a bias, has proven people wrong again and again and again. And of course, it just proves the theory that stock prices can keep going up well beyond your expectations again and again and again throughout history. But when you see what's going on in these themes, and then you look back over the last 10 years, of course, that's, the recency bias, confirmation bias, all these things that are concerning behaviorally. And then you just turn around and you say, I'm going to buy some Tesla stock. I'm going to buy the biotechs. I'm going to buy Moderna. I'm going to buy Pfizer and BioNTech, and I'm going to get into these CRISPR and I think those opportunities they're expensive, but when you look at I stand corrected. I know I'm rambling on here, but the biotech space, I was surprised to see how many of those companies who have such enormous futures in front of them were trading below $10 billion market cap, and many of them, in many cases, below $5 billion in market cap. They're all brand new, they're all companies with brand new innovations. And I think what I saw when you weigh those against, what people believed about Tesla just 3 years ago. Just 3 years ago, people thought Tesla was going to go out of business. They were going to run out of money, and that was going to be that. I mean, Citron, all the shorts that have been proven wrong, or at least have paid dearly for it in the last year. Though you really have to take a closer look at some of these themes and the valuations. I think there's a lot of difficulty when you're looking at something like Tesla as a key holding in some of these thematic funds. Whether or not it's worth more than the entire auto industry is difficult to reconcile. But so was Apple, right? I mean, wasn't Apple, a surprise? Like, does anybody understand? Is it too difficult to determine what the value of brand equity is? When a company comes along, and I'm by no means advocating for whether or not it's the right time or the wrong time to buy, a thematic ETF in the innovation space. But when you look at what, one particular company has done to change the view of innovation and the future of the automobile and space travel and satellite data for internet, isn't it almost impossible to reach a conclusion about whether or not the valuations are outlandish or somehow reasonable, or I think based on all the previous models of valuation and discounted cash flows, you can throw all that out the window, as investors certainly have, in terms of is this company worth hundreds of times its earnings or thousands of times its earnings, or does it even make money? Those are the difficult cases. But in the case of these companies like Tesla, for example, if you listen, for example, to Ron Barron, he certainly makes a compelling case about whether or not these companies are going to be worth $2 or $3 trillion down the road or not.
Well, I think that sort of goes to what, Mark, you were talking about earlier, the positive feedback loop that occurs, and this may or may not be late stage or late cycle behavior. All right. And if it's late cycle behavior, it can go on. Late cycles can last a long, long time. So they can continue to make things look wonderful for long periods of time.
It looks like it.
Yeah. And Mark was saying that earlier about how the feedback loops, right? So if Tesla, now that it's in the S&P 500, it has non-sensitive price buyers, right? So when anyone goes to buy any kind of index, a market capitalization weighted index, they buy X percentage of Tesla. And it doesn't matter what valuation that is at. The indices are not sensitive to that.
Yeah.
And so they have this infinite cash flow loop. And then the other thing I think that we've seen done, and Mark, I'd love to have your insights on this, is that a lot of these companies have created followings that are incredible. Like they're sort of I don't know, a club, a cult, if you will, cult following. So maybe you want to comment on that a little bit more and dig into that a little bit more, Mark.
Well, there's certainly, I certainly think it's psychological, right? If you're a fundamental investor, you're not buying these themes. Like you just can't, right? And they're just not going to fit any kind of financial modeling for you to look at them from a fundamental perspective. The way this stuff gets valued is on forward earnings growth, generally speaking. If there's any kind of fundamental metric, it's, well, they continue to grow their earnings. Or if it's Netflix, they continue to grow their subscribers. If it's Tesla, they continue to sell more cars, even if they're not profitable or not, right? That's all anyone's looking for. Eventually, it stops somewhere. What that moment of where it stops, I don't go, but where like I don't know. It really does, those sort of belie to what Mike is getting at, is the psychological behavior. And where we see it most acute actually is in cryptocurrencies. So on cryptocurrencies, there's no fundamental basis for Bitcoin other than you've got millions of people that believe that it should be the new standard of value for the world, right? And that faith supports it the same way that faith supports the astronomical growth and valuations that we've seen on Spider-Man 1s and Mickey Mantle rookie cards and all kinds of collectibles, right? You're in a sort of a mania phase in terms of just people believing that there's a growth to this. So, and we know that at a certain point, this ends, right? When it ends, I don't know, but it does end, because at a certain point, whether it's rising interest rates, whether it's economic disappointment, it gets to the point where, future growth is not worth paying for now with money I don't have, right? And that's where things hit the road. I don't know when that occurs or where, and I would never want to guess when it is, but you're absolutely right in terms of what is driving this, and we're seeing it in the inflows, is primarily retail investors buying and continuously buying religiously based on whatever positive metric is being thrown their way. And if you go back to 1998, 1999, the same thing existed, right? Where people talked about the potential growth of companies, and they kept going. Then in 2002, 2003, it hit an inflection point where there was no more liquidity to come into the marketplace, no more leverage to come into the marketplace to support it, and things started to drop. And then the floor comes out always a lot faster than it does on the rise, right? Because then you end up with that psychological impact. At some point in time, I do believe this happens in this current marketplace, simply because there's got to be disappointments with some of these companies. Some of these companies are going to be disappointing at some point in time. Like, I don't know if it's Tesla, but one of the other, Tesla wannabes will likely, fall apart. We saw that a little bit with Nikola, right? For example, some of these companies come in and they blow up. And it's hard to know when that will be. For the ETF perspective, this is why there's this diversified thematic play with people moving there. But I really think that I have to agree with Mike. It's a psychological thing, because it defies any classical understanding of fundamental valuations, which is always a really scary place to be. Because if you change your mindset as an investor to move from a fundamental rational frame of mind to one that's trying to guess what the masses are going to be valuing things at, that's where you can run into a lot of problems in investing in things.
Sure. It feels dangerous. I just wanted to just cap off what I said, because I think there's this, indiscriminate, there's this cohort of investors that are just buying, these companies or these themes that are, in the stratosphere indiscriminately, because they're sitting there thinking, I should just buy some. What if I'm wrong? What if I've just been wrong all along? What if I'm wrong about the next 10 years? And so it's faithless buying, really. It's not buying because you have
price insensitive buying.
Yeah,
for a
it's
number
not because
of reasons that may not be economically.
It's totally indiscriminate. It's really just FOMO. And what if I'm wrong? What if I've been wrong all along?
Okay, well, I want to take the other side of this argument, though. Now.
Yeah.
All right.
All right,
do it.
So now I'm like, no way. The world is changing faster than it's ever changed before, and we're seeing a flood of liquidity hit the market. So one of the things that I know we'll want to talk about a little later, but we have printed 25% basically globally of all the money that's ever existed in the last year.
Mm-hmm. Right.
And so part of what we're seeing is a result of a massive amount of liquidity entering the marketplace and chasing fewer assets. We didn't print 25% more stocks or real estate or commodities over the last year. We printed fiat currency of 25% extra over the last year. And so that is going to have some unintended consequences, one of which is to put a whole bunch of money into the hands of all kinds of different investors, both retail and institutional. And the next thing it does is it either continues to suppress, or in this case, suppressed long-term interest rates to areas where what is the discounted cash flow valuation of a company that has good growth over the next 10 years when your discounted cash flow number is 0.5% or was 1% and it fell to 0.5%. So from a rational perspective, you can get some rationality wrapped around that. And then I'd argue on Tesla, well, what if the Tesla battery tech is the battery tech that goes into every car or every electric car that enters the market? What if that is true? Yeah. What if Tesla creates valuation? So, Amazon's a great example of this. Back 7 years ago, people were talking about Amazon being overvalued. And if you were to do the calculation on, if they were going to meet their earnings projections, they would have to deliver every package on the planet. But then they came with this thing called AWS, and AWS now represents more than half of the profitability of the firm.
Right.
And so, I think that's the point you're kind of trying to raise, Pierre's.
Yeah.
Who, what, how does it happen? When are we paying too much? When aren't we? Those are great questions. I don't know if they're answerable. Like,
for example, 10 years ago, it cost $1 billion to sequence a genome. Mm-hmm. Now it costs 600. Mm-hmm. In 10 years, we've gone from a cost factor that was, a state-run cost factor that only a government could afford to raise, and now we can get our, it's only this year. I think the cost. This is according to ARC, of course, but this year it's come down to $600 to sequence your whole genome. So you look at a company, you look at healthcare and the future of healthcare. Who knows? What is a company like CRISPR? What are CRISPR and Pacific Biosciences, for example? What are they going to do? There's this is a whole new area of healthcare that is it hasn't been fully quantified yet. There's projections, obviously, but which are really incredible. But it changes our lives. Yep. Just like who knew? 2003, who knew that the iPod and then the iPhone, which was a phone attached to an iPod, who knew that was going to transform our lives the way that it has? I always recall the tech stories, and I mean Microsoft, where somebody said, "Oh, who the hell's going to have a computer in their home?" And when you go back to those examples, anyway. So that's basically the point you're getting to, which is that there's so many unknowns, and who are going to be the dominant players, Mark. And there's no way to know that. You certainly, going back and looking at companies like Alta Vista and Ask Mr. Jeeves. Yeah. Those are not the businesses you want to end up owning, but in the beginning you have to own them all. Otherwise you have no chance. So that's where, owning an index of some kind that owns an allocation in all of these companies is the way to go, because eventually the winners will outshine the losers, and the same way that they have in the S&P 500 and every other index.
Well, it's an interesting point. I think if you're going to buy the indexes, that's one thing. And the indexes garner the vast majority of the returns through a very small number of the participants in the indices. If you're going to thoughtfully think about how you diversify your market capitalization weighted portfolio, and I think this comes back to the core and explore, and what are going to be non-correlated industries that you might view as such that have drivers that are structurally different than the rest of the economy, that are taking advantage of massive waves in some sort of change. And I think the reason I bring up uranium as we're talking about all the innovation stuff is because those are two very, I think, reasonable thematic approaches, but they stem from very different initial conditions. But I think they're worthwhile considering if you're going to build a portfolio of stocks. Let's say you think about the S&P 500. If you're buying that, you're saying, I would like to perform like everybody else. I would like to be index in my performance, or I don't want to underperform anybody else, which is fine. If your thought is I actually would like to outperform everybody else, then by definition, you're going to have to do something different. We were just talking to Ted Sades, and one of the quotes in his book was something like, we want to be all the investors want to be the same except different. Right? They all want to be the same, except they want to outperform everybody else. But they want to outperform them.
Same, but different.
Yeah.
But you got to keep in mind that the S&P, this has been one of the worst years ever to own the S&P relative to other indices, the S&P 500 I'm referring to. So, you're up on a 1 year basis, around 45, 50% on the NASDAQ. You're up, way up on the Russell 2000 now with the cyclical move. And the S&P 500 hasn't done much of anything. And again, where it goes back to is, we talk about companies like CRISPR Technologies. If I look at what that business could be, feasibly, that could be a $3 trillion business. Okay. If CRISPR does what it's advertised to do in terms of letting us, resequence genomic code so that we can eliminate, terminal genetic illnesses, sky's the limit. But that company is not huge, right? And so what you're sort of seeing is sort of this mid-cap amount of money move into these companies that has really moved their valuation. And that's not being reflected in the S&P 500, right? Tesla was only added to the S&P 500 in the fall.
Yeah, last fall.
Right. And so, it's going to take a long time for that to work its way into the S&P 500. The companies that are leading the S&P 500 are basically the largest names that are also cross-listed on the NASDAQ. So, as an investor, this has been the first year for as a baseline exposure to the U.S. equities, you would have been better to own the NASDAQ and the Russell than own the S&P 500, where the S&P 500 in the past has much more captured some of that. This is where, we try to talk about things, not being different. This time is different. And I really don't believe this time is different. I believe, the rules of investing over a cycle apply, but certainly something different is happening in that you're seeing these tails, right? These tails in the equity market start to really diverge from the core of the S&P 500, where actually, if you look at the majority of companies in the S&P 500, they're actually well below their historical PEs if they're not in technology, right? And so this is a really interesting dynamic, and indexers have been punished for that, where people that have blown out their risk parameters to go after growth equities have been rewarded by the boatload. And I totally agree with Mike saying, look, a large portion of my portfolio was put in this Explore as well. I actually had to force myself to sell a bunch of my ETFs this year, simply because I'm I can't, I'm up and I'd love to keep making money on this, but it doesn't make sense for me to move forward with, my semiconductor position. I believe semiconductors are the new oil, right? They're in everything, right? They're Fred's, ranks red hot for the economy is semiconductors, and there's not enough of them to go around. So, there's definitely a play there. But if you look at the valuation perspective in terms of the divergence versus this traditional economy, traditional stocks, it's absolutely massive. And I don't have an answer for it other than it's deeply unsettling for me, because in the past, I could always point towards the S&P 500 outperforming about 90% of active managers. But this year, as managers move their benchmark from the S&P 500 to the NASDAQ 100, which is something that I'm seeing across the investment management industry, that's changing a lot. So you're seeing a lot more movement towards a smaller subset of growth stocks, ignoring this larger index that for my entire investment career has really been the paragon of market efficiency. I don't know what you think about that, Mike, but it is something that's very unsettling to me because it really moves against something that I've been kind of, it's been second nature to me to look into that as sort of your benchmark for efficiency.
Well, I think it's a great point of discussion to try and help those investors and advisors out there. First, that, okay, you have some equity beta premium that you're trying to harness, whether that's the TSX or the S&P 500. And that is about being average. You're the index. Now, you're going to own the average portfolio, and that ends up outperforming because of fees and all that sort of stuff. But then there are these areas where you can have thematic growth, waves of innovation, or and arguably that's what's going on in uranium right now. There's a wave of innovation that has been set by a very low point in the cycle. It's a commodity, just like oil is a commodity. And when you get a low point, it creates all kinds of efficiencies and it shuts down old production, brings on new production. The sourcing of oil and natural gas through what's that called? It escapes me. Fracking was another one where you had that type of an innovation that created a bit of a change. So in your portfolios, you should probably be having a more explore than you might think, right? But you really want that explore to be very, very different, riding a very different thematic wave that you've identified that's going to create some sort of movement from a current equilibrium to a disequilibrium, right, where you're going to appreciate in price because of that, to a new equilibrium where you are no longer in this new thematic wave, right? You're in a new equilibrium state. So you probably should be thinking about having, some thematic exposure through your explore part of your portfolio that's bigger than you think. The next thing is, how do we deal with that when we have big winners, right? And I think one way to think about that is to sort of think about your portfolio and set limits where you're going to say, well, I'm going to have, X% in my core, and then these other realms are going to be Y% of my portfolio. And I'm simply going to rebalance. I'm simply going to say, oh, my Explore version 1 has doubled. So I've got to bring that back down and I've got to reappropriate that to my other areas. And then maybe I've figured out a new thematic area that I want to jump into. And then the other is to look at the valuations to see if the Explorer that you've expressed an investment in is now reached a valuation such that even if it works out, you're only going to get average equity risk premium returns. Right. So if you're looking at buying, tech stocks in 2000, they were revolutionary. What we've experienced from 2000 to 2020 has changed in every way, the way we buy, purchase, get delivery of, sell things. But the valuations in 2000 were a bit extreme. And it took 14 years on that index, if you will, of the NASDAQ index, took 14 years to break even from a price perspective. Right. So I think if you think about the problem that we're all facing, and you say, okay, well, what do we do? Well, you probably have to think about, Explore needs to be something in my portfolio. And then I have to have rules around it to help me manage the overall risk in my portfolio. And your Explore needs to be harnessing structurally different drivers, like truly structurally different drivers. We saw that in 2020 with the drive to a mobile work environment. Right. So we had the correction, and then we had everyone realize, everyone's going to be working from home. And there's a whole group of stocks that benefited from that thematic play. And so I think that those are things tense. Yeah. So right now what was it? Like you said, Tesla, the whole vehicle industry, and what was the other one? Zoom was the same valuation as the whole airline industry, I think, or something like that.
Yeah, that's nuts.
It can be nuts. So you have to have some some way of keeping some sobriety within your portfolio as you're managing those explore portions of your portfolio.
But and I can get my head around that. I mean, like on the thematic ETF side, for example, where I tend to focus a lot of trying to talk to investors is looking not necessarily at the users of technology, but at the providers of technology, where you can determine a little bit more fundamental growth, right? So if you look at, let's take semiconductors, for example, Taiwan Semiconductor accounts for about 25 to 30% of the components used in semiconductors globally. If I look at all the smart cars, they're all using either AMD or NVIDIA chipsets. So if you pair it back and think thematically that, to your point, Mike, what are the different drivers? What we tend to get razzled and dazzled on the equity market are the users that are putting out the product, that have the marketing and have that cult-like following that I've been talking about. But sometimes what it misses is that a lot of those companies have to go back to the same distribution chain to get their component parts. So like East Asia is just dominating in terms of semiconductors, lithium battery components, sensor technologies, things like Kaons in Japan, robotics. And this is the stuff that I don't think investors quite have their head around, that really, if we get to a point where we reach that tipping point, Tesla may not be able to make cars if they can't get NVIDIA GPUs and they can't get lithium batteries for their lithium ion batteries. That's a real thing, right?
Yep. Mm-hmm.
Or they can't get rare earth metals from China. So that's kind of where, I've been kind of, again, pushing back that if you really think there's a secular long-term aspect to your point in the Explore, you can look at thematics that give you those buckets. And you'll notice the valuations based on revenue growth and drivers tend to be a little bit more in line with companies that have really interesting products, but actually aren't actually selling them, right? They have a product that looks like it'll capture it. So I do think that if we do have some sort of secular growth in thematics, I do think that the picks and shovels, for lack of a better term, are going to start to move beyond the users, particularly after we see the semiconductor shortage globally really put in framework the fact how many large chip-dependent companies are really hamstrung by the fact that they relate to a lot more smaller amount of providers on the foundry and semiconductor services. So that's, again, back to your point, Mike, that's where you'd fit on your exploration portfolio, something that's a little divergent that would still fit with your thematic bucket, but maybe you're getting it at a valuation that makes more sense in terms of economic.
Yeah, no, I think you're absolutely right. You don't want to just think at the tertiary level of I'm googly eyes over Tesla. You want to look down the supply chain of the things that they need to buy in order to accomplish what they're going to do or what they say they're going to do, and think about what the portfolio might look like beyond what's super obvious. And I think that is actually what you guys must ponder, as I've seen some of the ETF construction that Horizons has done, is that when they take a theme, there's going to be quite a swath of businesses in there where you look at the holdings and you say, oh, I didn't know those companies were sort of related to that. Maybe you can talk a little bit about that as you build a thematic exposure and how you make sure you capture the whole stack of what might be influenced.
That's exactly what I do. Yeah. Sorry, go ahead.
Right. I was just going to say, these are all these companies and providers who are at the periphery, who are feeding off the business, right? I mean, that are feeding the business, that are making it possible for the business to supply, to bring to market their products, like Tesla, for example, and its batteries. It's one thing to say we're going to make the best batteries in the world and we're going to dominate that space, but if you don't get the supply of the components, you're out of luck, no matter what.
Right. Exactly.
Yeah. Maybe right? Mark, you can take us through just an example of one of the ETFs that was constructed at Horizons and how you act, just so that we could all get a more solid grasp of how you might have done that.
So there's one that I did that based on cryptocurrencies, believe it or not. So that was the Horizons Big Data. We changed the name to Big Data because really when I started to look at the portfolio, it was actually a big data portfolio. So it's big data and hardware index ETF. And the idea here is if you have a belief in cryptocurrencies, we could debate all day long the merits of cryptocurrencies. But if you have a belief in the usage of blockchain and cryptocurrencies, you have to look at what's actually going to benefit the most from that infrastructure growth. Now, clearly, if you're offering coins or you own the coins, that's the commodity, right? That's what's involved. But because it's a digital infrastructure that's needed for cryptocurrencies, cloud computing, absolutely massive. You need to have absolute massive exposure to cloud computing. And we're seeing that massive drawdowns on space where you're actually hearing about Eastern European hacking groups hacking servers of North American data centers so that they can just mine Bitcoin. Like they're not even trying to do any kind of hacking. They just want their computational power to be doing more algorithmic changing. And then back to the foundry and semiconductor aspect as well. Like, are those high valuations? They are, but not at the exponential growth rate that you see. So the way that we built that thematic ETF is it's 1/3 cryptocurrency miners, and then it's 1/3 cloud computing, and it's 1/3 semiconductors. And what's really nice about that is when we had the big sell-off in cryptocurrencies in 2018, 2019, or especially going into 2019, the ETF, even though it had a fair amount of exposure to the pure play cryptocurrency miners, it still did relatively well because it had all the big data providers that were being used for everything else. So that's always how we're looking at thematics. We're looking at, we're going to launch a new product tomorrow, which is, again, we're showing the big leadership companies in battery technology, internet technology. It's called Bvig. So it's battery, biotech, internet, and gaming. Now it has some of the big users like CRISPR, Bluebird, things like that in biotechnology. But then on the battery side, we've got companies like Abermal, LG, POSCO Chemicals. These companies, again, are providing this. And what it's nice is it's an economic hedge, because if you have companies that meet that point of ruin that I talked about, you still have these other picks and shovel companies that are building the infrastructure of these themes. So I've been really trying to get investors that if you are buying into the themes, you have to take it all the way down the supply chain to see what is it that fundamentally is going to grow the most. And so you've seen, like, for example, exponential growth on lithium miners for obvious reasons. Like, believe it or not, lithium's a commodity. Energy usage globally because of cryptocurrency mining. That's why there's a big movement on clean energy with cryptocurrency investors, because at a certain point, governments are like, we can't have this huge drawdown on excess energy being used to mine cryptocurrencies. You've got to get a hydrogen or hydroelectric or something dealing with it. So, it's funny that as the world changes, it doesn't, right? It still comes back to what kind of things do we need to still get out of the ground to build the infrastructure we need for these transformational global changes.
Love it. So I think if you guys are okay, maybe we move a little bit off of thematic, but on to some of the other major topics that you're seeing at Horizons, and one of those was sort of the fixed income market, and maybe can you give us some insights into what you're seeing there from the investors that you're talking to? Yeah,
well, I was talking specifically to the retail advisor channel. The average client age is 69. So that's the average client age of a Canadian client now. And which means that for all intents and purposes, despite longevity, you need some fixed income in your portfolio. I have fixed income in my portfolio, and I'm 40, simply because as a risk off asset, nothing works better. The team at Resolve has some of the best data out there on holding, treasuries as your penultimate hedge. But
agreed.
What's happened is you have, 50% of portfolios are in income yielding products in the Canadian marketplace. And Canada has the highest proportion of fixed income ETF ownership in the world, 33% of the market. The Canadians love to pay a lot for cell phones, love to pay a lot for real estate, and they love to pay a lot for bonds. So, they have
Canada.
So you have this, it's a big deal. And so what I find really funny is we talk about thematic plays. And if you talk to advisors, they get their heads around, back to what Mike was going about. I know that, Tesla may be a risky play, but I've budgeted for that. What they don't budget for on the risk side is losses on the fixed income portfolio. They don't budget for losses. Like there's still this lingering view that somehow fixed income is risk-free. And maybe on the credit side it is for treasuries, but certainly not in the rest of the complex. And so what we're seeing is the fact that, keeping it very, very simple, if I've got a client who has $1 million fixed income portfolio, they could have been invested in effectively risk-free, close to risk-free bonds, 10-year U.S. Treasury, other than the interest rate risk, 3 years ago, and earning $30,000, $40,000. Maybe you up it a bit with some other corporate bonds. So you're getting them kind of like, you know, with a standard deviation of 2 or 3, you're getting them 4 or 5% a year. So they're making $50,000. That same portfolio, nothing has changed from a credit risk perspective. That same portfolio is getting you maybe $12,000, $15,000. And this has created an absolutely huge structural issue for the advice channel in that regardless of what's happening with the macro environment, I've got these older clients that need income and I've got to blow my entire portfolio risk budget to go after income. So what I'm seeing is classical, and actually this worries me way more than the thematic risk aspect, is I'm seeing classical psychological behavior where there's just like, what's yielding more? What can I get the most amount of yield for relative to the risk, and just assets flying that way. And ultimately that ends up being more problematic because, as I highlighted, the risk budget of the portfolio for a lot of advisors tends to be sort of understood on the equity side. Where you always have like big problems happen is when something blows up on the part of the portfolio that's not supposed to be, was supposed to be, you know, risk averse or, you know, whatever. And so and we're really seeing that problem manifest itself in the advisor world. Because again, back to this simple problem, my clients need income. If I'm to try to generate them the income that they're used to, I'm in some cases increasing the fixed income portfolio risk by 30, 40, maybe even 50%. And that's something that, you know, we've never really seen before in our career, where this asset class is terrible from a risk reward return profile.
Right. So you've got this chasing of yield due to the extremely low interest rate environment, but also it's the low rate environment on sovereigns, but also the spreads that you get from sovereign going up, you know, sort of the capital stack and moving into corporates and high yields. That also has compressed dramatically. And I think you're right. Most people, when you say, well, I'm going to buy a thematic and I'm going to buy my Bitcoin ETF or my Tesla, like, I'm prepared for that to have a major drawdown. I think you're right. They're not prepared for their, 5% high yield bond in junk expressly in one or two very narrow industries potentially.
Right.
They're not prepared for the equity risk that's embedded in that fixed income product. And that I think is something that it's interesting, because if you're worried about rates, if you're worried about interest rates rising and the impact on your portfolio, what you're saying is, I'm worried about duration. And when you're worried about duration, you're saying, well, how long is it going to take me to get paid back for, locking in this asset? And your highest duration assets, your longest duration assets are, large, growth stocks that have very high growth rates that have been priced into the future in order to make that multiple of their earnings work. And that's what we saw in Q1 with some of the growth stocks really kind of taking a pause in their upward trajectory as the yield curve started to correct a little bit, and we had a little bit of increase across the sovereign debt world. So we went from 50 or 60 basis points on the 10-year to over 1%, and I think so. People saw some correction in their equity market; they're used to that, but then they saw it in their bond portfolios. And they don't. It's not supposed to do that.
No, that's what the clients are calling them about. It's not that I've lost 10% on the NASDAQ. It's like, whatever. I've lost X percentage in this bond fund that I'm not supposed to lose money on.
That's my safe money.
Well, and the metrics, and really the key here is risk reward profile. So like if I take the broad benchmark, which is the FTSE TMX universe, which is like what all the Canadian bond managers benchmark themselves on. The duration on that is 8 years. Okay, so for every 1% rise in interest rates, you would lose 1% of it. So, you were already up 50 beeps. Yep, you've lost 4.5% already this year on that particular thing. But then it gets worse. It gets worse because
not only do you get that,
not only do you get that, but here comes the kick in the teeth, right? So
that's not all.
No, you also get the fact that a lot of the triple Bs, now not necessarily that benchmark, but it with low interest rates, the same thing that's affecting growth stocks affects fixed income. So if I'm a rating agency and I'm looking at a credit issuer and, they're triple B minus, so they're giving me that 3.5% I'm looking for, I'm like, I'll keep them at triple B minus, or I'll keep them at triple B because, with interest rates at 50 basis points, they're easily able to deal with their debt. But if we see a rise in interest rates on this triple B, which is, by the way, every active manager, if you ask them, how are you beating the benchmark? It's like, well, I own a lot more triple B because that's where I'm getting my excess yield. Well, guess what happens to that triple B if interest rates go up? It's not triple B anymore, right? The downgrade risk on the triple B side is also huge to that spread aspect that Mike's referring to as well. And so you have these multiple risk drivers here. And then at the end of the day, you also have investors simply like, I need 3%, right? I have $1 million. How can I have $1 million portfolio and be living on $20,000 of income? It doesn't work, right? That's not what I was earning to build this $1 million portfolio. So how do they meet this gap? And so it's a stretching on the credit, stretching on the yield. And then, unfortunately, my business doesn't help as well, because the reason ETFs are so successful in Canada for fixed income is because ETFs provide you this liquidity to buy, right? So they give you stock pricing on bonds. Otherwise, you'd be still buying from the bond trade guy down on Bay Street who, was charging you 2%, but you don't realize it, right? Yeah. So you have the ETFs that provide this transparency and liquidity, but a lot of the ETFs pay out fixed payouts. So a lot of the ETFs are still paying you like 3%. If you look at some of the broad bond indices, even some of my ETFs were doing this until recently. It's something that we try to rectify internally, but we're giving you 2.5%, 3%. But the yield to maturity on the ETF is like 1.1, 1.2. Now, if you yield to maturity is what you're going to earn on a go-forward basis. So basically what I'm giving you is a bunch of return on capital. You're looking at the ETF and saying it's low risk, it's lots of triple B, and I'm getting 3%, and you're buying it. But really what you're buying is something with 8 years of duration. A yield is a little bit over 1%, and about 30% of the portfolio is at risk of a downgrade.
Yeah.
I
will add one more wonderful bonus that you get. That now that asset class is also correlated to equities.
Yes.
So what you thought was a hedge, what was that magical hedge over the last, since 1982, basically that had a massive positive carry, now doesn't have that much of a positive carry. And because you've gone out the risk curve, behaves much more like equity. So you also have an asset class that's correlated to your equity portfolio, so that when equities do go down, if they go down due to some sort of inflation or interest rate shock, those bond portfolios are going to go down as well, for all the reasons that Mark pointed out. And that's a real challenge. And we see that constantly, right? So in the bond side of the portfolio, reaching for yield and making the bond side much more equity-like. You probably should just think about maybe shifting, if duration is your concern, take your longest duration assets and reduce those. Well, your longest duration assets are those very high growth, high valuation stocks that have no yield. Those are your longest duration assets. Mm-hmm. And so you might think about actually making your portfolio more conservative. But again, that flies in the face of your recency bias and your overconfidence bias. So it's a really hard thing to do. Just as you highlighted, Mark, earlier, I had to take my portfolio and move back out of thematic because, it wasn't making sense to me. And so you had some guardrails around how to do that. So are there any answers there for investors?
I mean, the one that's very counterintuitive, and I know I'm preaching to the choir on this one to you, Mike, but it's Treasury ETFs. And the reason being is, if you look at March 2020, so we want to talk about recency bias, just look 1 year ago, there was days during the worst of March 2020 where the only asset classes delivering a positive return were U.S. Treasuries and cash. Okay. and so what you can do is, look, if you know that you have this engendered risk in your fixed income portfolio, you can still fix the risk by having Treasury. So yes, maybe the 10-year goes to 250 again, and I'm going to lose another 3-4% on that Treasury bucket. That's possible, right? But what I can do is, if I over allocate to Treasuries or I have a higher allocation to Treasuries in my fixed income portfolio, at least I have that ballast. So I haven't changed the risk parameters of my total portfolio. And if, let's say this, $6 trillion of stimulus doesn't work, which is a real, people keep talking about this economic recovery like it's a given. If this stimulus doesn't work, and we don't see a real economic comeback if COVID, lingers, if we end up with COVID-22 or these variants. Like, there's so many bear risk factors that aren't being, and I'm generally optimistic, but there's so many risk factors that aren't being taken care of. If you put $6 trillion of stimulus on the global economy, if you put 25% of the world's monetary surplus and it does nothing, now you got a big, big problem, right?
Well, that goes to that ratio where they were, there was once a lot of talk about how, every $5 of stimulus, of money printing, was only producing $1 of growth.
Yeah, it's actually, right? The last survey showed, from the last stimulus check, showed that 25% is actually discretionary. The rest is savings and debt. But anyways, back to the treasuries. Deflationary environment, those can make 8-9%, right? They can really move for you as that asset class. And now your risk fixed income is put into that. Now your risk parameters are set. So then what you can do the rest of your fixed income portfolio is, now I can go and look at high yield, or now I can go and look at equity income or whatever, but I can match the risk, right? I can find a way to improve the credit risk by having treasuries. And now I can go short duration, high yield. Preferred shares preferred share ETFs are on a tear for a number of really important reasons. Secular reasons. The banks are going to basically redeem all their preferred shares potentially that are, above sort of 250 basis points over the next 2 to 3 years. About $13-14 billion will be redeemed. So all of these things have a pricing floor. They're yielding above 5%. So we're seeing lots of money moving to preferred share ETFs. That'll get you your 4.5%. Now it's equity risk, as Mike highlighted. But if I offset that with risk from the treasuries, this is just one example where I can, bring my risk parameters back in, it makes a lot more sense. So again, I may lose on the treasuries in the meantime, but it's got my balance, it's got my risk, and I can get my income from other places. The problem that you want to avoid is having just like broad investment grade credit exposure where your risk is not what you think it is, right? You just got all these things that can go wrong, and then you end up losing money on that portfolio. So that's, thinking from an ETF strategy standpoint, it's the idea of matching the risk. And the nice thing about ETFs is there's lots of opportunities for you to buy treasury ETFs, buy a diversified ETF, have someone like the team at Resolve who manages ETF for us, believe it or not, HIRA, where they have, a nice bucket in treasuries, again, where they're managing that risk. This is the kind of idea where you can use ETFs there. But, you want to have something the one aspect that I keep talking about, as I mentioned before, is what if we don't have an economic recovery? Because I've never seen so much consensus on economic recovery to the point where I get a little bit concerned that, that's probably all priced in. And there's still, I'm stuck at home for the next 2 weeks. There's probably still a lot of risk factors still out there that could derail that economic scenario.
Yeah, you've got demographics, you've got debt, you've got technological innovation, which in and of itself is deflationary. It's not inflationary from the productivity aspect of the side of things. So I think it's not a foregone conclusion that, all of a sudden growth is going to be robust and we're going to return to total normalcy. It's possible, but lots of things are possible. And so that's what creating a portfolio is. It's creating a portfolio of hedges to the potential future outcomes that you don't know. I always ask people, well, if you could admit to yourself that you didn't know anything, as in you didn't know the future, what portfolio would you hold? Right? If you could admit that you don't know what's going to happen, what would you hold? And then think about what you would hold, go from there and say, okay, what do I think would happen? And then probabilistically weight that. What's the probability I think that this or that happens? And then positioning your portfolio for those probabilities makes a great deal of sense to me. But it's a hard way to think. It's not particularly intuitive, as you mentioned.
It doesn't make for a good Reddit conversation, No. That's a 40-year-old guy and I'm 20% in treasuries.
Yeah.
Right?
Totally. I love it. You know what? You know what I love about? I love this conversation because, I after being an advisor for 15 years myself, I left the advisory business realizing that I knew so little, like nothing, about the fixed income market, and that was 20 years ago, and I think, if I was that naive about what the bond market was all about back then. I love the fact that we're having this conversation because it just proves to me that even when we started Advisor Analyst, for example, what launched Advisor Analyst was this ignorance about the bond market and what was going on in the great financial crisis and deflation. Right, deflation was a huge topic at the beginning, in our beginning, and now we're sort of rounding the corner. I think we had a conversation with Alex Shahidi and Damon Bassiri, and I sort of wondered out loud. I don't know if I wondered out loud how long it took. I mean, for people from the 70s who had really commodities and oil and things like that to benefit from, and equities were a complete write-off, and bonds reached their high yields, their low valuations in 81 with that Death of Equities article in Newsweek. That how long did it take after that turn of events for investors to realize there's a different cycle now? And
different regime. Yeah.
The regime has changed. Interest rates have peaked and are falling now. I'm still owning all these commodities and stuff that I picked up in the 70s, and I'm afraid to let them go. And what if this thing isn't for real? This new change, this new regime, and now we're like at the opposite end of that, aren't we? Like where the regime is changing slowly but surely, and how long is it going to take for investors and for advisors to realize? We're at the beginning. What if I do the wrong thing? What if I don't know what I'm talking about? I look at that and I think this is such a great conversation because, are a lot of people in the business just taking sort of the easy way out, the low hanging fruit of credit to get the stated yield? And making, the mistake where I wasn't even looking at fixed income to think that I was going to lose 10 or 15 or 20% there. And that's what I love about your point in the beginning, Mark, was that advisors are so busy, are so intent, so busy looking at equities. Where am I going to get the growth from? Where am I going to get the return on the equity side? And they're not paying attention to the fixed income side as much as they need to.
Well, they're paying attention, but they're maybe prioritizing. They're prioritizing the wrong major sort of input factors. Mm-hmm. And the funny thing about fixed income is that you can only make the coupon. That is your maximum return. Oh, and if you buy the bond at a discount, you can make that. But, basically you make the yield to maturity and no more. When you buy equities, you can have those major standard deviation events where you get the right tail, where you can have a massive return in one of your equities or one of your sectors that sort of compensates you for all of the other decisions that may have been less than optimal. Whereas bonds, if you make a boo-boo in your bond portfolio, it is very hard to make that boo-boo up. There's a very technical term, boo-boo. It's very hard to make up those mistakes or those negative returns with the balance of your portfolio, in particular in such a low yield environment, right? So if you happen to be in something in your fixed income portfolio, and let's say 10% of your fixed income portfolio disappears because, it was a triple B and it got downgraded and et cetera, et cetera. Well, at a 1.5% yield, that's 15 years of trying to make that up. Yep. Right. So it's incredibly important that investors and allocators approach the fixed income side of their portfolio with some real thought, because it is sourcing a different. Sovereign bonds are sourcing a truly unique source of risk that they're compensating you for. Mm-hmm. And it's not what equities are compensating you for. And it's not what commodities are compensating you for. So there's a very different source of risk there. But if you go into corporate credit and even more, and as you go through the balance sheet to high yield and whatnot, it gets more and more equity-like. And so the mistakes that you can make there in the context of your fixed income portfolio can be very meaningful and take a long time to recover from.
So the big crises come from fixed income, right? That's you look historically, when things go really bad, it's because the default risk is mispriced on credit of some kind. So whether it's in the derivatives market or whatever, somebody took for granted the risk to get that extra 50 basis points, and then it creates a cascading systemic risk because everyone relies on collateral and credit for the leverage, which funds everything else. And so that's why it's just so important to be watching it, because as you see volatility starting to really creep up in the credit market and the fixed income market, it means default risk is increasing. And if default risk happens at a large institutional level, that's where the systemic risk comes in. The Archegos thing recently was interesting, right? But they could write that off. But if that had been a lot more derivatives across a lot more, investment banks, that could have been really, really bad, even with that small amount of money, because all of a sudden those investment banks then have to start selling off high quality credit to fund collateral. And then people want to take a haircut on that. And then all of a sudden, what was worth $3 yesterday on a high investment grade bond is now worth $2, and down we go and down we go. Almost, and even in March of 2020, same thing, until the Fed came in and backstopped the corporate credit market. That's when the floor was coming out. So to your point, Pierre, it behooves us to really look at that market, because the really, really nasty black swan kind of risk that we talk about that nobody can predict usually comes from a mispricing of risk on that side of the balance sheet.
Well, certainly it's a much bigger market.
Yeah. All of the savings and loan crisis, the Latin American debt crisis, the housing crisis, all were a function of credit markets. And those are the big markets that make the oil to make the machine run smoothly. So what else you got? What else are you seeing, Mark? What are any other top themes that you want to cover today that you're seeing?
I think we've covered a lot, man. It's like an hour.
Of course we have.
And a half.
I'm just making sure there's not a diamond left in there. So then I won't.
The only interesting thing is just on marijuana stocks. Okay, this is kind of again on the explore portion. I don't know where this fits in the larger podcast, but
there's final thoughts. I love it. Yeah.
There's a crazy mispricing between U.S. marijuana stocks and Canadian LPs, and it's for structural reasons. So when I talk again about self-directed investors coming into the marketplace, most of the owners of marijuana stocks are retail investors. And so the largest swath of retail investors that you want to capture are the U.S. retail investors. Well, the U.S. retail investors can only buy Canadian LPs because Canadian LPs are the only stocks that are listed in the U.S., and that's because if I have a cultivation and distribution business in the U.S. as a marijuana provider, I can't get a U.S. stock listing because I'm actually running a federally illegal business, even if it's legal at the state level. So the U.S. MSOs are doing extraordinarily well. They raised, like, the U.S. marijuana profits last year, revenues, were $17.5 billion. In Canada, it was $2.6 billion. But the valuations recently have all been massively towards the Canadian LPs because the U.S. investors are really excited about buying legal marijuana companies. And so they're buying Kronos and Canopy and Tilray, Afria, which is a combined entity now. But those are Canadian companies. But because they're listed in the U.S., that's what they can buy. But the companies that are actually making like significant revenue, like actually a lot of the large U.S. providers have positive EBITDA, but they're only trading at like 6 to 9 times enterprise value to book, where the Canadian ones are trading at like 18 times enterprise value to book and have negative earnings. So it's like just the structure of the market. And again, talking about this really weird dynamic with self-directed investors, they're completely missing the boat by buying the wrong stocks that are going to benefit from U.S. legalization. So believe it or not, in this theme that's super overvalued, if I look at Canadian LPs, which are primarily held by the ETFs on both sides, it seems crazy, but the stocks that are actually benefiting the most from this are not widely held and can be accessed through, a couple of U.S. marijuana ETFs. Obviously, we have one, but it's hilarious that it's occurred, and it's simply because of the structural mechanism that U.S. investors can't buy U.S. pot stocks, so they're buying Canadian pot stocks, which really aren't going to benefit from U.S. legalization the way that U.S. pot stocks are.
Right, and the one that Horizons
that's a great
has,
insight.
That's you guys have both. You have the U.S. version and you have the Canadian version. So if for those people out there who are, hot on marijuana as a thematic, you might want to consider looking at the US version to get a much better valuation on the underlying businesses that you're buying.
Yeah, just interesting. Again, we're talking about the proclivities of thematic investing. There's a pocket of inefficiency in an inefficient space.
Yeah.
I love it.
Lots of stuff like that happens too. I think that's, that requires that extra bit of research, if you will.
That's a nice little nugget. That's a nice little nugget to cap off the discussion.
I said, sell it all, buy the other one. No, the other
treasures, buying treasures.
Okay. So this wouldn't be raise your average if we didn't cap it off with the final question. All right, which is a would you rather question. Okay, would you rather spend a week in the past or a week in the future, and why?
No question, a week in the past. I'd have the knowledge of the future to benefit. Why would that doesn't? Yeah, that's a no-brainer.
Everyone says it differently. I mean, if you
the point is that we keep talking about the fact that we have to build these portfolios of unknowns, right, to deal with these unknowns, because the real crisis is never priced in, right? It's a real crisis because nobody anticipated it. Well, if I have that knowledge of what happens in the future, I'm going to go and selling my treasuries and buy some hot stocks.
A week is a long time, isn't it? Like if you really stop and think about it.
And I'm leveraging it like 50 to 1. I'm going to call our Kikos guys. Oh man, it's gonna be
you can't even get account set up in a week.
Settlement is all wrong. I mean, you go to the past, it's T plus 5.
I guess the question is, do you have material non-public information?
They won't know that, right? So, yeah.
Guys,
I'm from the future.
I'm from the future. I'm going to buy some stuff. I have material non-public information because I'm from the future. I just want you to know that in advance.
Forward to the past.
Yeah.
I love it.
Forward to the past.
Yeah.
There you go.
All right, gentlemen. Well, that was great. Mark, thank you very much for your time.
Yeah. I hope it worked.
Thank you, Mark.
Looking for. So thanks very much.
It was awesome. That was awesome, Mark. You know what? I love hanging out with you because you've always got so much to share. You've got the pulse on so many different angles in the market and aspects of the market. So thank you so much. It's been time well spent.
I'm really enjoying this series, man. You got the right guys, the resolved guys, man. So it's always fun listening to the picture there. So it's been a good series. So I'm just really honored to be invited. Thanks very much.